Today's UK economy presents a mixed picture of cautious optimism amid ongoing challenges. As of December 2025, recent data shows signs of easing pressures on households, with inflation cooling faster than expected, interest rates being cut, and the pound holding steady against major currencies. However, the cost of living remains elevated compared to pre-pandemic levels, unemployment is ticking higher, and growth prospects for 2026 are modest at best. This script explores the latest inflation trends, movements in the pound sterling, the lingering impact on the cost of living, and broader implications for consumers, businesses, and policymakers. Inflation in the UK has shown a welcome decline in recent months, providing some relief after years of elevated price pressures stemming from the pandemic, energy shocks, and global supply disruptions. According to the Office for National Statistics, the Consumer Prices Index (CPI) inflation rate fell to 3.2% in November 2025, down from 3.6% in October and marking the lowest level in 8 months. This drop exceeded most economists' forecasts of 3.5% and even undershot the Bank of England's own prediction of 3.4%. The primary driver behind this slowdown was a sharp moderation in food and non-alcoholic beverage prices, which rose by just 4.2% year-on-year in November compared to 4.9% the previous month. Items like cakes, biscuits, and breakfast cereals saw notable price falls this year, contrasting with rises in 2024. Core inflation, which excludes volatile items like energy, food, alcohol, and tobacco, also eased to 3.2% from 3.4%, reaching its lowest since December 2024. Services inflation, a key focus for the Bank of England due to its reflection of domestic pressures, dipped slightly to 4.4%. Other contributors to the slowdown included tobacco prices, which eased after a large duty-driven increase a year ago, and greater discounting in clothing during Black Friday sales. On a monthly basis, CPI actually fell by 0.2% in November, highlighting the disinflationary momentum. This cooling comes against a backdrop of persistent above-target inflation throughout much of 2025. Earlier in the year, food inflation had been stubbornly high, contributing to broader cost pressures. Housing and household services continued to make the largest upward contribution to the headline rate, at 1.44 percentage points, though this was down slightly from October. Overall, the November figures suggest that the peak inflationary pressures from 2022-2023 are firmly in the rearview mirror, but prices remain significantly higher than pre-pandemic norms, with cumulative inflation since 2019 exceeding 25% in many essential categories. The Bank of England's response to these trends has been measured but proactive. On December 18, 2025, the Monetary Policy Committee voted 5-4 to cut the bank rate by 0.25 percentage points to 3.75%, the lowest level in nearly 3 years. This narrow decision reflected divisions within the committee, with 4 members preferring to hold rates at 4% amid concerns over lingering services inflation and potential second-round effects from wage pressures. Governor Andrew Bailey noted that future cuts would be a closer call, signaling a gradual approach to easing. The cut was widely anticipated following the softer inflation print and signs of economic stagnation, with GDP expected to be flat in Q4 2025. This marks the latest in a series of reductions since the cycle peaked, aimed at supporting growth without reigniting inflation. Lower rates should eventually feed through to cheaper borrowing for households and businesses, particularly benefiting mortgage holders on variable or tracker deals. However, with inflation still above the 2% target, the bank has emphasized data dependence, cautioning against overly aggressive easing. Turning to the pound sterling, its performance has been relatively resilient in 2025. As of December 24, 2025, GBP USD is trading around 1.3516, down slightly on the day but up approximately 8% over the past 12 months, one of the strongest annual gains since 2017. This strength reflects a combination of factors: a weaker US dollar amid expectations of Federal Reserve cuts, relative stability in UK monetary policy compared to peers, and perceptions of the UK economy avoiding a deep recession. The pound's appreciation has made imports cheaper, helping to dampen imported inflation, particularly beneficial for energy and goods prices. However, it poses challenges for exporters, making UK goods more expensive abroad at a time when global trade growth is slowing. Sterling's performance against the euro has been more muted, but overall, the currency's robustness provides a buffer against external shocks. Market reactions to the December rate cut were mild, with the pound holding steady as the move was priced in. Despite these positive developments on inflation and currency, the cost of living crisis continues to weigh heavily on many UK households. Although headline inflation has moderated and real wage growth has turned positive, with regular earnings rising around 4.6% in recent periods, outpacing inflation, prices for essentials remain far above pre-pandemic levels. Food bills, energy costs, and housing expenses have cumulatively risen sharply since 2021, eroding purchasing power for low- and middle-income families. Surveys from organizations like the Joseph Rowntree Foundation indicate that millions are still struggling, with low-income households cutting back on heating, food, and toiletries. Unemployment has risen to 5.1% in the 3 months to October 2025, the highest since early 2021, adding to financial insecurity. Youth unemployment in particular has climbed to 16%, raising long-term concerns about scarring effects on younger generations. The crisis has been unevenly felt, with lower-income and vulnerable groups hit hardest. Energy price caps, while lower than peaks, still reflect high wholesale costs, and rent increases in the private sector continue to outpace wages in many regions. Government support measures, such as uprating benefits and pensions, have provided some mitigation, but fiscal constraints limit further large-scale interventions. Looking ahead to 2026, forecasts suggest subdued growth of around 1.0% to 1.4%, with risks tilted to the downside due to weakening consumer confidence, a softening labor market, and global uncertainties like potential U.S. tariffs. Inflation is expected to ease further toward the 2% target by mid-year, potentially allowing additional rate cuts to 3.25%, 3.5%. Wage growth should moderate to around 3 to 4%, supporting real income gains but reflecting cooler labor demand. Business investment remains constrained by uncertainty, though sectors like renewables and data centers offer bright spots. Net trade may provide limited support, with exports facing headwinds. Overall, the UK economy appears set for a soft landing, but structural challenges, low productivity, demographic shifts, and post-Brexit adjustments will require sustained policy focus to unlock stronger potential growth. In summary, while inflation trends are encouraging, the pound is stable, and monetary policy is supportive, the cost of living impact lingers, and economic momentum is fragile. Households may see gradual relief in 2026 through lower borrowing costs and moderating prices, but vigilance is needed to ensure inclusive recovery. Policymakers face the delicate task of nurturing growth while anchoring inflation expectations in an environment where external risks abound. This evolving situation underscores the resilience of the UK economy, but also highlights the need for targeted measures to address inequality and boost productivity. As we move into the new year, all eyes will be on incoming data to gauge whether this cautious optimism materializes into broader-based improvement.